Imagine a company that's called the Amazon of the health and life sciences world. A giant that provides everything from the most basic test tube to the most complex machines that analyze human DNA. If there's a lab anywhere in the world, there's almost a 100% chance it has one of their products inside. I'm talking about Thermo Fisher Scientific, ticker TMO. Today, we're going to dive deep into this company's investment story. We'll understand how they built a nearly unbeatable economic moat, how they're handling the current crisis in the biopharma industry, and most importantly, if they're still the capital allocation machine they've always been. In this video, we'll cover everything. Their aggressive acquisition strategy of over $50 billion, a direct comparison with rivals like Danaher and Agilent, the bulls versus bears argument, and the hidden risks. If you're looking for high-quality companies for a long-term portfolio, stick around until the end. Get your coffee ready, because this is a complete lesson on Thermo Fisher. The business model and strategy. To start, we need to understand what Thermo Fisher actually sells. Their strategy is simple, but incredibly hard to copy: to be the one-stop shop for science. They don't want to be the best just at microscopes or just at reagents. They want to own the entire ecosystem. Fundamental analysis shows us something crucial. While bigger isn't always better, Thermo Fisher has proven that in this industry, scale is everything. Since 2010, they've invested over $50 billion in acquisitions. This includes the massive purchase of PPD, a clinical research giant. Why does this matter? Because it created an unmatched portfolio. But it's not all sunshine right now. The company is facing some challenges. 1. Post-pandemic slowdown. The COVID boom is over. 2. China. The Chinese economy has slowed down, affecting demand. 3. Biopharma squeeze. Biotech companies have tighter budgets. However, Thermo's strategy is long-term. While smaller competitors struggle to keep the lights on, Thermo uses its production and logistics power to gain market share. The expectation is that the current tough environment will continue, with growth returning to normal only in 2026. It's a story of resilience now, to reap growth later. Economic advantage and technology. Now let's get to the core of the story, the economic moat. Thermo Fisher has a competitive advantage that's considered wide, based on switching costs, intangible assets, and scale. 1. Switching costs. First, it's very hard to switch from Thermo. The process of making a medicine is strictly regulated. If you use a thermo mass spectrometer to validate your medicine, switching to a competitor's would require new FDA validation, stop production, and cost millions. This creates recurring and sticky revenue. 2. The instrument battle. And here it's worth pausing to look at the competition. When we talk about high-precision analytical instruments, like mass spectrometry and chromatography, Thermo isn't playing alone. They're going head-to-head with Agilent Technologies, ticker A. Agilent is a formidable and focused player. The crucial difference here is strategy. Agilent specializes and fights for technical leadership purely in the instrument. Thermo Fisher uses these high-tech instruments as a Trojan horse. Thermo's goal is to install the machine in the lab and then secure the contract for all the consumables and services around it. While Agilent competes for the best machine, Thermo competes to own the entire lab. This strengthens Thermo's economic advantage as they capture more value per customer. 3. Scale and distribution network. And this brings us to the third point: the brute force of sales. Thermo Fisher's sales team is by far the largest in the industry. Their revenue, excluding diagnostics, is almost equal to the sum of the next 3 largest competitors combined. Remember the old Fisher Scientific catalog? That has evolved into a digital dominance. For a lab, it's much easier to buy everything, from reagents to services, from a single supplier. Recurring revenue and PPD. One point many investors miss is the quality of revenue. In the past, they sold a lot of machines, instruments, which is a one-time sale, CapEx. Today, 82% of Thermo's total sales come from consumables and services. Consumables are like razor blades. You buy the shaver once, but you need to buy chemical reagents every week. This makes the company less sensitive to economic cycles. Here's where the recent masterstroke comes in: the acquisition of PPD. PPD is a CRO, contract research organization. Basically, pharmaceutical companies outsource clinical trials to PPD. By buying PPD, Thermo closed the loop. Now they provide the equipment for drug discovery and conduct the clinical trials for approval. It was the missing piece to solidify their customer relationships. Market context and bulls versus bears. Before we weigh the current pros and cons, we need to put Thermo in context against its arch rival at the top of the food chain, Danaher, ticker DHR. Many investors are unsure between the two. Think of it this way: Danaher is famous for the Danaher Business System, DBS. Obsessively focused on margin improvement and operational efficiency, they tend to operate in very high-margin niches and have recently done spin-offs to focus even more. Thermo Fisher, on the other hand, plays the game of scale and volume. They want to be the Amazon of science. While Danaher seeks operational perfection in niches, Thermo continues to gobble up the market to be omnipresent. Both are excellent capital allocators, but Thermo wins in logistical reach and the ability to be a one-stop shop supplier for large pharmaceutical companies. That said, let's get to the current debate about TMO. The bear case: negatives. Tariff uncertainty. Trade wars introduce uncertainty into industry costs. China weakness. 2025 was tough in China, and 2026 is expected to be lukewarm. Government risk. Cuts in research grants in the United States could affect the academic channel. The bull case. Positives. Cost control. Thermo is elite at maintaining margins even with falling sales. PPD gaining market share. The clinical services business is growing above average. Pricing power. Thermo can pass on inflation to prices, proving the strength of its portfolio. Financial strength and capital allocation. Let's look at the company's wallet. Is Thermo Fisher a good payer? At the end of 2024, leverage went up to buy PPD with about $31 billion in obligations. But the company generates an absurd amount of cash flow. The debt-to-EBITDA ratio is quickly falling towards 2 times, which is very healthy. Management receives an exemplary rating from Morningstar. Successful M&A, they have an almost flawless track record of integrating acquisitions and extracting synergies. Low dividends. They intentionally pay low dividends, preferring to reinvest or buy back shares, which has historically generated much more shareholder value. Risks. To wrap up, where could you lose money here? Dependence on capital. If funding for biotechs dries up, sales fall. Industry cyclicality. The semiconductor and industrial parts are cyclical. Note: Thermo Fisher is a world leader in electron microscopes through the acquisition of a company called FEI Company in 2016. Chip giants like Intel, TSMC, Samsung buy these extremely expensive electron microscopes from Thermo Fisher for metrology and failure analysis. ESG tax risk. The company's tax efficiency is so good that it attracts the attention of regulators. Conclusion and verdict. Thermo Fisher. Scientific is a masterclass in building a legal monopoly through competence and scale. It's not a get-rich-quick stock, it's a compounder story. We're talking about a company that knew how to use one of the worst economic periods to solidify its leadership, with a portfolio focused on recurring revenue. If you believe the world will demand more healthcare and research in the next 20 years, Thermo is the toll on that road. But now I want to know from you. In the clash of titans, do you prefer Thermo Fisher's scale or Danaher's efficiency? Let me know in the comments. Thanks for watching and happy investing.